Hello and welcome to our channel. In this video, we break down the key takeaways from our recent deep dive report on Eli Lilly $2.3 billion acquisition of Icos in 2007. Our report covers the strategic rationale behind the deal, the financial analysis, the due diligence considerations, and the overall impact on both companies. If you are interested in more details, please refer to the provided link. But for now, let's get straight into the key highlights from the report, and here is our summary. In 2007, Eli Lilly acquired Icos Corporation for $2.3 billion or $34 per share. While Icos struggled with failed oncology assets and a lackluster pipeline performance, it held the co-development rights to Cialis, a PDE5 inhibitor for erectile dysfunction or ED. This strategic acquisition allowed Lilly to gain full control of Cialis, which went on to become one of the world's top-selling ED treatments, rivaling Pfizer's Viagra. This deal exemplifies the classic biotech value rescue model wherein a big pharma firm acquires a distressed company through a single late-stage or commercial-stage asset with blockbuster potential while writing off or disregarding the rest of the pipeline. In our view, this transaction highlights three interesting aspects. First, big pharma companies have greater marketing power, global reach, and lifecycle management capabilities than their smaller biotech peers. Second, even a blockbuster asset can be trapped in a distressed corporate structure, creating ripe M&A targets. And third, large pharma companies can unlock significant value by acquiring smaller firms at attractive valuations. With that, let's dive into the deal's specifics and strategic rationale. Lilly and Icos had partnered up in 1996 to co-develop and commercialize Cialis. However, Icos had limited resources and lacked the commercial infrastructure to fully develop the product globally. Under the original agreement, both companies shared profits and costs related to Cialis but had different objectives. Icos needed the upfront capital to fund its struggling pipeline, while Lilly sought long-term growth opportunities. Around 2007, Icos's pipeline had largely underperformed expectations, especially in oncology. Management felt pressure from shareholders to monetize its most valuable asset, Cialis. Concurrently, Lilly recognized an opportunity to consolidate full commercialization rights for Cialis globally and eliminate the complexities of co-commercialization. The strategic goals of the acquisition were for Lilly to gain full revenue ownership of Cialis, resolve operational inefficiencies from co-commercialization, improve global brand consistency and marketing scale, and absorb Icos's manufacturing and distribution assets. Now moving to the deal structure and financial terms, the total acquisition value was $2.3 billion or roughly $34 per share. The deal was structured as a cash transaction and it was motivated by the acquisition of Cialis commercialization rights. The deal was announced in June 2007 and finalized in late 2007. From Lilly's perspective, the deal was immediately accretive to earnings upon closing, and the upfront cash consideration represented less than 5 times trailing 12-month EBITDA. Cialis generated over $2 billion in annual peak sales before generic erosion. And the deal enabled Lilly to reposition Cialis for BPH or benign prostatic hyperplasia, thereby extending its indication and product lifecycle. Next, we analyze the due diligence considerations. Eli Lilly's strategic due diligence likely focused on 3 key areas. First, assessing the current market share, trajectory, and future growth of Cialis versus Viagra. Second, forecasting cost savings from eliminating joint operations and associated overhead. And third, evaluating branding, lifecycle extension strategies, and additional market access gains outside of the US. Meanwhile, Icos' due diligence likely centered around ensuring the fair valuation of its key assets and resolving outstanding liabilities. Given Icos' struggles, it is reasonable to assume that its oncology pipeline was viewed as a sunk cost and therefore disregarded in the transaction. Moving to the SWOT analysis, we highlight the following. On the positive side, the acquisition provided Lilly with full commercialization rights to a global ED blockbuster. It also delivered operational efficiency from vertical integration and expanded the use case for Cialis post-acquisition. With regard to threats, Lilly paid a high premium for one asset, and its other pipeline assets were negligible. In the short term, the deal faced criticism for Lilly paying too much for Icos given its multiple failed clinical trials. Moreover, there may have been integration risks related to corporate culture and operations. On the opportunities side, the deal opened doors for Lilly to expand its brand footprint beyond 𝗏 into the broader urology space. Moreover, there were significant opportunities for lifecycle management and formulation improvements to further drive Cialis adoption. Finally, Lilly could leverage its global pricing power to optimize Cialis sales in various regions. Finally, some key strategic takeaways. We believe this transaction stands as a case study in how late-stage clinical or commercial assets can be significantly undervalued due to organizational underperformance. Specifically, big pharma companies have greater marketing power, global reach, and lifecycle management capabilities than their smaller biotech peers. As such, they can unlock significant value from smaller firms at attractive valuations. Moreover, even a blockbuster asset like Cialis can be trapped in a distressed corporate structure. Therefore, big pharma companies can identify stranded value, eliminate operational inefficiencies, and grow their brand dominance through acquisitions. With that, we wrap up our analysis of Eli Lilly's acquisition of Icos, and if you enjoyed this analysis, please hit the like button and subscribe for more content. Thanks for watching.